Ladies and gentlemen, welcome. This is your partner in business and personal growth, FCPA John Mudanyi. I want to invite you to subscribe to this YouTube channel by pressing subscribe and also pressing thumbs up as a symbol that you like it. Today I'm talking on the subject renewable financing renewable energy. This is part 2. Now, renewable energy, what's renewable energy? Renewable energy is any form of energy whose source is naturally replenished or renewed. And the examples are solar, we've got wind, we've got hydropower, we've got geothermal, we have biogas. So you may find those forms that are renewable by itself. There is a natural way of the energy source renewing itself or recycling itself and sustaining that power. So how do you finance this project? Because Africa has abundant of renewable energy. If we talk about a country like Kenya, it's estimated that Kenya has up to 10,000 megawatts of geothermal, numerous sources of hydropower. Solar energy could be anything up to 4,000 megawatts. Wind could be 7,000. Lots of that. So there's a lot of energy sources that can be exploited, and the measurement continues. Now, how do we finance renewable energy? Financing renewable energy, there are two ways. Number one is what we call the equity financer, which is the sponsors or the shareholders that will be putting their money into the business, and they are the risk takers in terms of they're the investors. So equity has to be part of this, and these around maybe 20%, could be anything between 40% to 15% of the project cost. The second form of financing is the debt component. Now, in terms of equity in financial, you will need what's called a share purchase agreement or shareholders agreement among the shareholders that will entail the component they're buying and the terms and the conditions of that. And then we've got the loan agreement, which is the agreement between the lenders or the banks and the sponsors of that project. So you'll find that most of the time, the debt financials will give you maybe 60%, 70%, 80%, or the top side could be up to 85%. Now, we begin by equity. Equity is very important because the banks will not finance any project 100%. So you always need the investors or the sponsors to put their component of the funding. And these could come from different sources, could come from sponsors' own source. You could raise this through the stock market, capital markets, like Nairobi Securities Exchange or London Securities Exchange or Johannesburg or any other international security exchange. You can also get these from private equity investors. These are really investors that have money that they are ready to put into different projects. They could have $20 million project. It could be up to even to $1 billion. It could have P's, private equity that have got a fund that have got quite a big chunk. But you could also have those that invest. They could give you $5 million, could give you 10, 20 million, up to 50 million, depending on how they assess. Normally, the source of funding for these private equity investors are from high worth individuals. They could be from some families. They could also be funds that have been consolidated from various other funds, and most of them are found basically. You find some of them in London, you find some of them in New York, you could find them in Hong Kong and Singapore. There are also quite a number that are coming in Africa that are developing PEs, private equity, and they're interested in different sectors of the economy. There could be those that are interested in energy. There are those that are interested in industry and manufacturing. There could be others that are different. Others that are generally interested in emerging markets or all that. So those are potential investors that could sponsor or put in equity into your business. The second is the debt financing. The debt financing, normally you will have to borrow either from a bank. It could also come from some of the P's could also give, but normally you'll get either from a commercial bank. And there are different funds. There could also be different funds like solar energy fund. You could find a green energy fund. debt could also be from bonds. There are green bonds, there are public infrastructure bonds, there could be corporate bonds. Now, when we're talking about this, there are two ways of doing it, debt. There could be corporate finance, which is really loans that you get, and the security is based on the balance sheet of the sponsoring organization. So if the balance sheet is strong enough and can take up the loan, the financiers will look at this plus the project, and they could give you a loan. It could be a commercial loan, could be anything from 10 years. Okay, some could be very short, could be maybe from 5 years. Most commercial banks will want 5, at least they get really security, and then they will go up to 10 and then have 12. And but for energy, renewable energy projects, really the minimum should be around 12 years to 18 years. Preferably even 20 money, but do not get so many. They require a lot of things. But there are many ways you can go around that. You can take, for example, short, and then at the year you again you top up, or you could get a mix of debt financials. For example, you get you do a corporate loan, and then later you get some other short-term or mezzanine financiers, which is a combination of debt and pseudo equity. That can be all convertible things, just to make it easy. Also, you could find take those loans that after a certain period, again you're able to top up again and increase it as time goes by. Thereby, the lender is reducing their risk. But broadly, there's a corporate debt which relies on the balance sheet, and there's also the project finance. The project finance is non-recourse. There could be non-recourse that depends entirely on the cash flows and the conditions and the terms of the project itself that's being financed. So they will rely on this project and depend on the cash flows that will come from it. It will be from the security, and the financiers will just rely on that. So these are ways that you can finance your renewable energy. But to finance this, I think one of the key things is that you need to have a power purchase agreement. Let me take one step back. You need three things. Number one, you need land, because renewable energy require a big chunk of land. So you need a big, either you've leased a land or you own a land, a big chunk of land. Most investors prefer leasing the land. So you need to have a land agreement to confirm that you have land in the resource area. You need to have a generation or a license from the regulating authority in the country they're talking about, that you can license. You've been licensed to generate and to produce energy. And number three, you need a power purchase agreement, so that there is the off-taker, the person that's going to buy the energy they're going to generate. Normally could be the disco company, or the distribution company in the country, or whatever it is that going to. So you need to have a power purchase agreement. Of course, again, because financiers are taking risks, they would want to have a feasibility study, so that it gives them assurance that there's a market to it, they have studied and everything, and the project is viable. With all that, then now you get the equity investors, and then you get the debt financiers, and the debt financier can be a mix of corporate. If it's corporate, you will have a different mix. If it's private equity, then of course it will. If it's a project finance, you will rely entirely on the project cash flows and the terms. These financials will come their conditions. They will normally put some conditions or terms that they want to be guaranteed, normally called the covenants that they come on, and they would include debt service coverage ratio, which shows that the project is able to generate cash flow to pay for the borrowings. They would want you to have some leverage ratio, debt equity ratio. They would also have some reserve account or reserve fund, where you put some money aside for 6 months, 3 to 6 months loan repayment that they require. All that is what you need for financing energy. This has been your partner in business and personal growth, FCPA John Mudanyi, talking about financing renewable energy in Africa. Please remember to subscribe. Press subscribe. Also like my page. Press the thumbs up. And also you can find me in YouTube. You can find me in Facebook, in Instagram, and in LinkedIn. Thank you so much, FCPA John Mudanyi. Remember to subscribe. God bless you. God bless you, and bye.